Good afternoon, everybody, and welcome to the Fintech Nexus weekly news show. My name is Peter Renton, Chairman and co-founder of Fintech Nexus, joined, as always, by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
Doing great. And back with us this week, we have the one and only Andrew Dix from Crowdfund Insider. How are you doing, Andrew?
I'm doing well, Peter. Good to see you, Todd.
Yep, you as well.
Okay, let's kick it off. We got a lot to cover today. So we're going to kick it off with a Wall Street Journal article about Sam Bankman-Fried. So SBF, as he is known, a 30-year-old spending $1 billion to save crypto. I think he might be even spending more than that, to be honest. But he's made some pretty major plays over the last few months. It's becoming, I keep thinking of like the JP Morgan coming to the rescue, like 1907 or whatever, when there was a major recession in the US, and this JP Morgan came to the rescue, and that's sort of what's happening here, just for the crypto space. And he's made some good moves. He's made some moves that haven't paid off. But anyway, what do you guys think of this piece?
Well, I think the interesting thing about him individually is that he doesn't seek some of this. Mm-hmm. And so I think it even makes him more appealing in the end, that he's not one of these rah-rah crypto enthusiasts. He also wants to help remake equities trading and other automated or other markets a lot more automated and a lot more real time. And so I think it plays into this good of the industry feeling versus maybe some of the crypto guys out there that can come off really negatively and way too enthusiastic and screw the banks and that type of talk. So I think he's also, the fact that they made so much money for that period of time has helped boost their coffers. They also raised a bunch of money and has really been able to put it to work to kind of keep either some as a lifeline or to prop up some companies for an eventual acquisition. So I think it's been a fascinating journey. He's become kind of the crypto name these days.
Mm-hmm.
Yeah, well, he is. He's become like the crypto Fed, the lender of last resort,
right?
Because everybody's running to him to get a bailout when you need it. I'd be interested to hear which bets you think are the good ones, Peter. But first, I'd like to say that, you're right. It does sound familiar. You look at long-term capital management in the 80s and how, the sky was going to fall. And then when, Lehman tumbled and nobody did anything, I think he recognizes this is a time where he has the capital, he has the knowledge that it's better to step in and invest or take over companies that have the ability to survive or have some value to it, and and help the industry and ecosystem mature. Obviously, he's shouldering a lot of risk. Clearly, he avoided Celsius. I don't think anybody really wants Celsius.
Right.
I think Voyager may not work out so well, but BlockFi may. And
yeah,
time will tell. Smart guy. As I've mentioned before, I've watched him on Capitol Hill doing hearings, and he's definitely the smartest guy in the room.
Right. Yeah. Okay. Speaking of smartest guys in the room, we're going to talk about Goldman Sachs, who often say that, but they're having some challenges. Real interesting piece in Bloomberg this week, talking about the Marcus checking account, which was originally promised for middle of last year, and now that's obviously over a year late, and now was supposed to be done by December, and now they're saying they may shelve it for a considerable time because they've had all sorts of problems. We've actually talked about their problems on the show in recent weeks, with executives leaving. There's infighting in the leadership, and the thing about it is, the checking account is so competitive these days. Lots of big banks spending a fortune on it, and when are we going to see the Goldman Sachs checking account, the Marcus checking account, I should say? And I was actually looking forward to it, but who knows if and when it's going to come.
I think there is a real possibility that we don't see it at this stage. I think we probably still will if you had to bet, but I think there's a distinct possibility they could shelve it all together and figure out another avenue. I think the next piece, or I think we can even rope it into this conversation with Ron Shevlin's piece, is how he talks about where the checking account is going. I think Peter and I disagree a little bit in the current state of the checking account. I think it's still very much core to a person's financial life today. I think in the future, maybe not. But people still route most of their activities through a core checking account and have ancillary accounts. And I don't think the more Marcus delays, the less chance it's going to be an impactful product. That's for sure.
When you guys brought up the Bloomberg article, I went back and I looked at their Q2 earnings, which I listened to, which are always edifying, largely due to the analyst questions and not the actual report. But it didn't sound at that time that they were having these types of struggles, and that was weeks or a month or so ago, a couple months ago. So it makes me wonder what else is going on now. What are they seeing in the economy today, and how is that impacting their business during this quarter and the following quarter? Of course, the Bloomberg article could be off base. Somebody's leaking something to be salacious or ulterior motives. We won't really know until the next quarterly report, or they make a statement in advance of that. I don't know if you guys want to jump into the Shevlin article. I will say this is that paycheck motels, I kind of like that. I think
he's been using that term for a little while. Yeah,
it's kind of true, and I think Todd, you're right. People just funnel their money to the checking account because you need kind of a current account, and that tends to be the one. I mean, why put it in a savings account? You're not making any real money there, right?
Nope. Yeah, and I think that's the thing that I still see. Like, when you get your pay in wherever your pay goes, it may, even if you're just using it as a way to disseminate the rest of your money, it's still, that's the place that is going to be central in your consciousness in a way, because that's where your money's going in. That's the plus side of the column is with that account. And so I think that's a pretty powerful thing. Still, I don't quite agree that with Shevlin. I think we may, as time goes on and we may, when we get to programmable money and whole kind of different infrastructure in play, who knows? But I think today, the checking account is still really important. I also think Marcus is going to do it. I think they've probably gone too far down to they're not going to cancel it, I don't think. But,
I do think that on the checking account part, I do think as more payroll linked things like I think it's Argyle and Atomic, more of those options are out there that make switching and where your pay goes very, very simple. I think you'll see the checking account be less and less important. There's not a ton of that out there yet. And it's not, for most people, it's not that simple to kind of toggle a number just yet. If it gets to that point, I think it makes the checking account a lot less valuable. But today, the checking account, I think, is still super valuable.
Mm-hmm. The checking account's just a hook. It's everything else you want people doing there, and their build out has been methodical, to be diplomatic. But it's just a hook. You want all these other ancillary services of transfers and wealth and lending and more, interacting or intertwining services, but the checkbook can be a starting point. I still think they're going to come out before the end of the year, unless something catastrophic happens. I just don't see them delaying it any further for something like that.
Right. Well, We will
We'll see.
see. We will be reporting on it if and when it happens, because waiting for some time.
Yeah.
Okay, let's move on. Ramp. We know Ramp from their their spending management, their corporate card. They were sort of a Brex competitor before Brex kind of went away from the small business side of things. But Ramp is doing buy now, pay later for business. I'm really bullish on this category. I think it's got a lot of legs, and they're coming out with their own product. There's no big brand yet in buy now, pay later for business. I think there's going to be. Ramp wants to be one of them. They've got this new Flex product where you can basically pay back in 30, 60, or 90 days for a small fee, and who knows whether they'll get traction. It's a little bit more challenging because small businesses are more complex than consumers, but I think this is a good move from Ramp.
Maybe you could explain to me, why is this just semantics? Because you just have all these other, businesses that are providing credit to SMEs, based on invoicing and other things. Should we really call it BNPL, or maybe it's just because it's a buzzy term, it raises its profile? Are we talking about semantics? It's all credit, right?
Yeah, I mean, it is somewhat semantics, but I mean, this is the whole idea of BNPL is you pay regularly over a short period of time.
I think it's kind of more productizing the invoice financing industry and in smaller incremental payments versus right now it's you send out the invoice and then you're hopeful to get it paid in whatever the time period is. This gives businesses to say, all right, I'll pay 30% of it X amount of times, or however the payment fees are. I think it, I guess, gives the lender a bit more of a hold on, all right, they're actually going to pay this back versus an invoice paid in full in 30, 60, or 90 days. But yeah, I mean, in some ways it is semantics.
Yeah, and like we had at our USA event, we had Fundbox and Visa making the announcement that their Fundbox is doing buy now, pay later with Visa, and it's you can call it a loan, you can call it really a sort of an installment plan, but it's everyone calls it buy now, pay later. It's still a hot term. Like when we write buy now, pay later stuff, I don't know about you, Andrew, it still gets good coverage, gets good readership. So people are still interested.
And it's that I think some of it's the psychology of, if I can pay small amounts, that's different than paying a lump sum in 30 days or 60 or 90 days. I think some of it's playing with someone's minds.
Okay.
Yeah, I think
go on.
Yeah, go ahead.
Okay, let's move on. Let's move on. So I want to talk about this piece. This is big banks with mentioning Goldman Sachs and JP Morgan, another Wall Street Journal article. They're aiming for a Wall Street built on blockchain, and this is basically talking about what Goldman Sachs is doing. They're already trading bonds, they're trading securities on the blockchain. They're looking to build their own platform. JP Morgan's already built their own platform called Onyx. I found out that in this article they say it was $350 billion of repo transactions that are processed through the Onyx platform. That's a large number. And so the point is, big banks are still bullish on blockchain. A lot of them are not these sort of public blockchains that many are used to. These are more private blockchains, but still the technology itself has legs on Wall Street, it seems.
I mean, this is I think the potential big impact of the technology is if, the example, I think in the article with the Goldman bond that they referenced, it was 100 million and it would normally take 5 days. In the example, it took 1 hour and it settled. And so that almost immediately eliminates counterparty risk and whether or not they're going to pay up what is owed. And if that takes place across Wall Street, I mean, it brings down costs and it brings down risk significantly if it's settled in a matter of hours.
I've been saying this for a while. The biggest near-term value creation or utility for blockchain or distributed ledger technology is back office, because back office is so not sexy and nobody really cares about it except the banks that have to pay for it. And most people on the street look at you like you're a loon if you ask them what it is. But it's just a huge cost. It's a huge operational endeavor, and blockchain can fix and address all that, reducing friction, reducing time, reducing cost. And that's where you have these incremental costs that are just going to go away. And it's a huge win for big banks. It's a huge win for people that are pushing boxes of files and papers around. They won't have to do that anymore. And you also won't have to pay those people to push those piles of paper around anymore. That's a huge value that nobody really cares about, nobody really talks about except in this article.
Right. Okay, let's move on. We're going to talk about the CFPB. There was an interesting article in American Banker this week about basically the brouhaha that's going down around P2P payments fraud. We've got, there's all this complaints about Zelle that the CFPB are getting. And, because, if you have fraud on a credit card, we all know that we're covered. We don't have to worry about the charges that a criminal might rack up on our card. And now if you do it if you pay someone through Zelle, not the same thing. And CFPB seem to be arguing that it probably should be, but then you look at the laws here and they talk about this Electronic Fund Transfer Act of 1978. Okay, this is about electronic fund
Did they
transfer.
have electricity back then?
Yeah, and so this was when banks were electronically transferring funds between each other. There was no electronics happening between a consumer and a bank or a consumer and a consumer as far as funds go. So that needs to be updated, and we got to get to the bottom of this because Zelle and Venmo use more and more. Criminals love it. They can trick people into sending them money, and are the banks going to have to pay? It's interesting. What do you think, Andrew?
Banks are going to pay, man. You can't fight the CFPB. Don't fight the man. The CFPB will win. The banks will sue. It'll go on for years and years and years. There's no victory in store for them. But in the end, the consumers really pay because, we'll get nickel and dime with it somewhere. And what they say about the fool and its money. But yeah, it'll be a very popular move for the CFPB because you're removing liability for people's stupidity or people getting trapped by nefarious actors, which there will always be a lot of people. I'm sure each of you, both of you, have had your credit card pilfered in probably in the recent years. And I actually once filled the gas tank of a large truck in Italy while I was driving around Cleveland, Ohio. And
mine was a pet store in Germany.
And American Express called me. I was driving in my car, and they say, "Are you in Italy?" No. So you didn't fill it with diesel? No. They're like, okay, bye. So yeah, CFPB is gonna move the liability to the banks. It's just gonna happen.
Right.
I think the other part that I think Peter, I think who was it, Aaron Klein?
Yes.
It's highlighted the point. I mean, we've talked about this before. Is that the Fed system still not being updated, and they're coming out with Fed Now sometime in the near future. He called it a disgrace in the article. Some of this would be helpful to have this to solve some of these issues, but I mean, I think the larger point is the banks are going to have to pay, and ultimately they'll probably pass that on to us. Maybe they can take some of the savings from the blockchain back office and kind of equal them out.
All right, way to sort of weave that in there, Todd. Okay,
perfect. Yeah.
All right, let's talk about the Coinbase CEO. He was on CNBC this week. Brian Armstrong, Kate Rooney interviewed him. It was a full half-hour interview. I haven't actually watched the whole thing. I watched the 2-minute highlights, and just basically say it was a pretty, I would say, particularly in the highlights, he was somewhat contrite and really thoughtful and saying, you know what, we're cutting costs, we're trying to get clarity with the SEC. We know that that fee that we like trading revenue is going to be compressed eventually, because it's just, he said that was that's inevitable. And he wants to build up his subscription business. And I think Coinbase has struggled because of the downturn in crypto, but I always am impressed when I hear him speak strong. What do you guys think?
You rarely get a CEO of a publicly traded company being this transparent in his comments. Many times you get these long-winded answers that kind of say nothing when they're trying to say a lot, but they ultimately say nothing. And so, I think he was pretty honest about the headwinds that they face today, where he wants the business to go, and they ultimately got ahead of their skis a little bit when it was the crypto boom. And I'm curious, when another bull run comes in crypto, kind of how different some of these companies operate, and how that might turn out versus this time, which seems like a lot of them hired a shit ton of people to keep up with the volumes, when now it's probably going to be a little bit different.
Mm-hmm.
Yeah, I think Armstrong's a solid CEO, and you make a good observation there, Todd. But he's a true entrepreneur. Most establishment CEOs say a lot but say nothing at all. And I think that it's helpful when you have somebody actually wants to have a conversation. I think Coinbase is doing what a lot of other platforms are doing, just from different directions. Because I think in the long run, people want to go to a central provider, a single provider, to fulfill many different types of services, as opposed to opening multiple apps. And they're just approaching it in a different way. They've got a head start for a lot of things, and some things they're behind. I think their biggest risks beyond cost structure and their crypto winter or freeze or whatever it is regulatory. And I think that is something that remains unresolved. I want to mention the Gensler op-ed that came out a few days ago.
Yep.
Talking about regulating crypto and comparing it to seatbelts in cars. It's an interesting allegory, but it's very simplistic. There's a lot more going on there. There's a lot of battles on Capitol Hill. Is it a commodity? Is it a security? Is it a utility? Is it none of the above or all of the above? We still don't have resolution on that. And that needs to take place first. And until then, the opaque regulatory environment creates headline risk for all these platforms.
And that's the thing. I saw that op-ed and I thought, oh, good, there's going to be some news here. There was nothing. There was basically
nope.
There was nothing. He just basically reiterated what he said in the past. So
Gensler will tell you anything except what you want to hear.
Right.
But he's a politician. He's not a regulator.
Yeah, exactly. And that's the key. I think a lot of the stuff that's happening right now is because he has political aspirations, or aspirations beyond the SEC. Let's just say that. Okay. Want to talk about an article in CoinDesk. This is an interesting one. Talking about Chris Dixon, who is the head of Andreessen's crypto arm, the investing arm. And he basically was saying that I love this quote: the idea of having the internet controlled by 5 companies is very bad for entrepreneurs and bad for VCs. And so he's talking about how the balance of the balance of power, that with Web3 we can sort of take that balance and make it more egalitarian, shall we say.
I mean, there are some people like Jack Dorsey who disagree and put out there that the current Web3 still incentivizes the VCs, and they can cobble up tokens and they can take ownership. All of our hope is that Web3 is more democratic than Web2 was. I think it still remained to be seen. I think the other interesting part was, that we've heard many times is the crypto winter is a great time to buy and great time to invest and build. And while there'll be some pain, there'll be a lot that comes out of it that's beneficial for the market overall.
Right.
Yeah, I'm going to disagree with Dixon. I don't think that it's a bad thing that you have large tech, um, you know, I wouldn't say controlling, but being a highway for the global internet. These large companies have generated enormous and incredible value. They took something that really didn't exist just a couple decades ago, and they made it incredibly viable. Driving productivity and fostering a new generation of entrepreneurs and innovation. So to sit there and say it's bad, I think it's bullshit. I think I'm gonna call him out on that. That's wrong. But things do change and things will evolve. The one thing you can always count on is change never stops, and that's where people like Dixon and many other people see Web3 being the next iteration. Obviously Web 1, Web 2, Web 3. Whether it'll come to fruition in the way they envision it, I don't know. I still think we're in the first days or weeks. We have a long ways to go before a lot of this stuff manifests itself in a way that really is going to drive value. And you look at some of these big tech firms, a lot of them took a long time to really establish themselves. And but I think there's a lot of opportunity there. And I agree, a downturn, when there's blood in the street, that's when you buy.
Yep, that's what he also said in that piece. So let's move to an article in Bloomberg that came out this morning talking about Bank of America. Bank of America, not really we haven't talked about them much on the show. There's not a whole lot been happening, but they had 2.8 billion logins in their electronic platforms last quarter. It's basically a billion a month. And they so they're consequently, basically the article's about they're beefing up their tech offerings. They got a guy in charge of bringing out this, improving their existing systems, adding on new systems. So just thought I'd just mention it real quick because I think they're kind of a. I said
You don't hear from them very often.
They're a sleeping giant in a way, and we don't.
Yeah, it's like you hear Jamie Dimon, JP Morgan, you hear how Citi's restructuring and kind of bringing everyone back to the US, kind of getting out of the global markets. And then it's just like Bank of America slowly and underneath everyone building, and some of their digital offerings have been adopted by their users probably more than any other big bank.
Mm-hmm.
Yeah, well, I mean, this is honestly, I saw the headline and I skipped it because I'm like, if it's not clear to every financial service industry participant in the world right now that everything is going digital and we're going to be managing everything on our iPhone, well, then there's we're all doing something wrong, I guess.
Fair enough. Yep.
I mean, good Lord. I mean, yeah, people are logging in on time. I will mention that we had a short piece recently where the CMA, the Competition and Markets Authority in the UK, was talking about, they did a survey of the most popular banks. And the UK, as you guys know, has long been dominated by 4 or 5 high street banks where they just did whatever they want. But it's also a very robust market for fintechs and digital banks. And 1 and 2 were, Monzo and Starling and Monzo.
Mm-hmm.
So I don't know about if they've done prior surveys, but it shows that people are looking for convenience. They're looking for value. They're not looking to go wait in a queue at a Bank of America retail location. Who wants to do that? I mean, it's like, who wants to go to the dentist? I don't want to go.
Right. Okay. Anyway, let's end with staying over on the pond here, Andrew, and one that I know, a company that you follow very closely, Cedars. They just crossed £2 billion. So just give us a rundown of what's going on there.
Yeah, so they had a short note on their site that it took them 8 years to get to 1 billion in online capital formation, and this is early stage startups, growth stage, venture firms, and it's taken them 2 years to top that next billion. So you're seeing some growth there in a very nascent market, but a very important one. And I think it's going to continue to head in that direction. And specifically with Seedrs, due to two things. They've been acquired by Republic. Republic is one of the largest platforms in the United States that has global ambitions. They're gearing up in Asia. This is their European venture. And the harmonization of the regulatory environment for online capital formation in the European Union, which will effectively, go into place. I think now they pushed it back to next year, but that's going to create a huge opportunity for raising money online for private firms globally.
Mm-hmm.
And so, kudos to them, kudos to the industry. This is something that, had a lot of initial love, but then kind of, due to crypto and other things, people lost interest. But I think it's, full steam ahead. You're going to see ongoing growth. And like Coinbases of the world and like some of these other platforms, they're going to start offering more features and bigger services over time to make it easier for people to get the services they want in one location.
Right. Okay. Well, that's it. We are over time. I'll have to leave it there. Thank you, Todd. Thank you, Andrew.
Thanks, Andrew.
Before we go, though,
Thank
just
you.
a quick plug for our Merge event, which is happening in London. It's going to be talking all about the intersection of Web3 and traditional finance, October 17th and 18th in London. Go to fintechnexus.com to find out more. And with that, we'll be back same time next week. I don't know if Todd's going to be with us, though. He is expecting a baby any day now.
Congratulations, or soon to be.
Thank you.
Baby number 2 is on the way very soon. And
very soon.
I will be here, and we will have another great news show, I'm sure. So thanks again, guys. We'll see you next time. Bye.
See ya.
Thank you.